Three of Britain's most internationally recognized financial names shed between 5 and 6% in a single session, and the FTSE 100 still closed higher. That is not how the index is supposed to work. HSBC, Standard Chartered, and Prudential all fell sharply on Thursday after the South China Morning Post reported that mainland Chinese residents are facing new constraints on opening offshore investment accounts at Hong Kong banks. A Shanghai branch of the Bank of East Asia had already suspended account openings. HSBC staff in Lujiazui were telling customers that all funds in investment accounts must comply with Hong Kong regulatory requirements. The regulatory signal was clear enough for the market to act immediately. Shares in HSBC fell 6.3%. Standard Chartered dropped around 5%, and Prudential followed close behind. These are not peripheral names in the FTSE 100. HSBC is consistently one of the index's largest components by market capitalization. A move of that magnitude in a single session would ordinarily drag the whole index into the red. Instead, the FTSE 100 closed up 0.27%. The divergence points to something that shifted in how the index is now weighted. Earlier this week, the quarterly reshuffle confirmed Computacenter, Investec, and Aberdeen's promotion to the blue chip index, while Berkeley Group and Rightmove dropped out. Computacenter, a Hatfield-based data center infrastructure specialist with clients including Elon Musk's xAI, entered with a market value of around $4.7 billion. Its pre-tax profit for the year is running materially ahead of the $291 million analyst consensus. The timing places a domestically focused AI infrastructure-adjacent company into the index precisely as the China-exposed cohort repriced. The UK construction PMI, meanwhile, fell to 38.2 in May from 39.7 in April, its lowest in 6 years, extending the sector's contraction streak to 17 consecutive months. That data registered almost no visible market reaction. The FTSE 100 is not a reflection of the UK domestic economy. It is a portfolio of globally dispersed revenue streams, and on Thursday, the weighting of those streams shifted in real time. The China offshore account story is worth examining as a position pressure event, rather than a regulatory headline. The unstated premise behind the sharp bank sell-off is that the offshore account channel was functioning as a meaningful revenue and assets under management growth driver for HSBC and Standard Chartered's Hong Kong and wealth management divisions. When the South China Morning Post reported the restrictions, sell-side desks repositioned on that premise, not on confirmed earnings impact. The sell-off preceded any guidance revision, any management comment, and any quantified flow number from the banks themselves. That sequencing matters. Institutional desks moved first, and the bank's own statements had not yet arrived. The open question is whether the premise holds at full strength. China has tightened and relaxed offshore financial access before. The Bank of East Asia suspension might represent a localized compliance precaution rather than a systemic policy shift. HSBC and Standard Chartered were not immediately available for comment when Reuters contacted them, which means the market priced a permanent tightening, while the evidence supported, at most, a directional signal from state-adjacent media. AIA Group fell 6.8% in Hong Kong on the same news, reinforcing that the selling was not confined to FTSE-listed names. The transmission ran across asset classes and jurisdictions within hours. That cross-market speed is itself informative. It suggests the capital moving out of these names was not value-seeking rotation, but risk reduction positioning. The selling was not the product of a new fundamental analysis. It was the product of a changed position risk assumption. Standard thread. If China's restrictions are confirmed as broad policy, the affected banks lose a growth channel that Western analysts had partially embedded in medium-term wealth management revenue projections for the Hong Kong business. Countersignal. If the restrictions prove localized, re-entry into HSBC and Standard Chartered becomes a candidate trade, as the sell-off overshot the underlying information. The unresolved question from Thursday's session is not whether China's regulatory intent is real. It almost certainly is. But whether the scope of the restriction matches the price action that followed. HSBC's Hong Kong Wealth and Retail Banking division has been one of the few growth levers that justified the stock's valuation premium over purely domestic European banks. The China offshore account channel fed that division. If the restrictions are confirmed as permanent and broad, the valuation framework for HSBC shifts, not by one sessions move, but by recalibrating the medium-term growth multiple that offshore wealth expansion had been supporting. That recalibration has not yet occurred in analyst models because no official guidance exists. The historical parallel is not exact, but visible. In 2021, regulatory tightening across multiple Chinese sectors, technology, education, property, moved faster in market pricing than in policy documentation. In each case, the first sell-off in UK-listed China-exposed stocks overshot the confirmed policy change, then partially recovered when the scope proved narrower than feared. Standard Chartered retraced roughly half of its initial drop within 2 weeks in several of those episodes. The recovery was not driven by improved fundamentals, it was driven by the confirmation gap closing. For the current episode, the verification benchmark is explicit. Whether further Hong Kong banks formally suspend or restrict mainland offshore accounts in the coming sessions, and whether HSBC issues guidance revision or management commentary on the scope of regulatory contact. If additional banks announce suspension and HSBC's management provides no pushback to the SCMP framing, the Thursday sell-off represents the first leg of a longer repositioning. If no further suspensions materialize and management speaks to the restriction as localized, the position pressure on UK-listed Asia-exposed financials dissipates. The FTSE 100's green close on Thursday reflected the index's changing composition more than it reflected the health of its largest financial names. Computacenter's entry, along with Investec and Aberdeen, shifted the weighting toward domestically anchored revenues. That composition change absorbed the bank sell-off on Thursday, but it will not absorb a second, deeper move if policy confirmation follows. The question for the next session is whether the South China Morning Post story was a policy signal or a compliance footnote. The banks themselves have not answered that yet. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.